Due to popular demand and many requests, I have created a guide video that you guys will come back to. Now, this is a comprehensive video. It's going to be a little bit longer. This is going to be chaptered, but I want you to use it as a guide that you can consistently come back to over and over for any questions that you have on your journey in trading. This is the most requested video that I've ever had. It's a complete guide to trading. Let's get right into it. The first thing and most important thing when it comes to trading, in my opinion, is volume. Volume is the gasoline that you put in your car. If you don't have gasoline in your car, you're not going to go anywhere. So volume is something that is incredibly important, and you have those volume bars here at the bottom of your daily chart. Why is it important to track volume? Well, think about it like this. If you want a stock price to go up, if you want this to happen, you're typically going to need some pretty good volume coming into it. So when you look at volume, you're looking at something that almost propels the stock forward. So if you're buying a stock, if you want the stock price to go up, you want to look for good, consistent volume, meaning that there's a lot of buyers in the market. There's a lot of consensus, a lot of people on your side. You can see here, and in most cases, this will happen. If you get a lot of good, consistent volume, the stock price is going to go up. A lot of good, consistent volume, the stock price is going to go up. There will be cases, however, where the stock price will go up, but the volume will not be there. And that's almost a fake out. You think about it this way. You start your car, you just floor it and you start going very, very fast, but you're running on empty. All of a sudden you get down the line, let's say you're going a quarter mile, you go an eighth of a mile and you run out of gas and you stop and you can't get the quarter mile done. That is because you don't have any gas in your car. That's because you don't have any volume. So what you'll see with that is a stock price, a volume that's very low, we'll say somewhere down here, the stock price moves up and then it pulls all the way back on you and you just don't end up going anywhere. So to drive this point home, you really need to pay attention to your volume, and your volume is always going to be accessed here on your daily chart. If I click it this way, it's your long-term chart, your daily chart. You want to have that detail here at the bottom of your daily chart. And I prefer having an average line there. So you can see where the average volume is over the last 30 days. And you can see how that yellow line fluctuates, but it just gives you a sense of where you need to be to say, yes, I have good volume coming into the stock. I can comfortably execute my order based off of that volume piece of the checklist. Now, we move on to the trend. And as you're going to notice in this video, I'm kind of going through things almost down my trading checklist. There's going to be a lot more to it because this is a fully comprehensive video, but these are really important things that I will look for before I go and execute a trade. So the second thing is the trend. Now you have trend in different areas of the chart. Of course, you have your weekly trend over here, which is tracking week to week. And you can see up here how it says 1W right there. 1W means 1 week. So it's giving you that long-term trend. So if we are looking at these two charts and just comparing them, this is the exact same thing. You have your daily candles over here, replicated daily candles over here. But if you look at the trend on the bottom, down here you have a lot of squiggly lines going up and down every which way. Now, if you look over here, you don't have a lot of those squiggly lines. That's because here you're tracking the day-to-day. You're getting a lot more movement. So each one of these price action moves, you're getting movement of your daily trend because it is 1 day. Now over here, it's going to take a while to move trend. For those of you who want to trade at a less demanding pace, maybe your job doesn't afford you to be able to sit on your computer and check this for hours a day, or you can't day trade. Well, you can come over here and you can check it once a day. Why? Because that trend down here is so slow moving. Trend is typically not going to change regularly on a long-term chart. Now, when we're looking at the trend, we want to have the highest probability to buy a stock or to sell a stock short. And where is that area? Well, on a chart, it's between your sweet spot. It's your area between these two horizontal lines on both charts for that matter. So over here, you want to buy your stock if you're going along somewhere in here. Why? Because it's going to give you the highest probability to make money. The whole point of trading is to put the odds in your favor. Are you going to win every single time? Absolutely not. It's just not possible. But your losses will be minimized. And you need to buy when the odds are in your favor. And that's exactly what we have here going on with Google currently is, yes, you had a sweet spot reversal, didn't start at the bottom, but sweet spot reversals are okay. But you can see what happened. As this trend started to move up, what happened to the stock price? It continues to climb actually to all-time highs right now. Now, When you come over to a daily chart, it's a very similar situation. It just moves a little bit faster. These are moving more quickly. You can see the reversal happened here, and what happened in these 5 days? The stock price ran up. When you had these a couple days coming down, what happened? The stock price ran down. So it's happening a lot faster over here on the daily chart. But you have a lot more opportunities to make quick money here on the daily chart versus here. In summary, though, of trend, it doesn't matter which chart you're using. You need to trust your trend. The trend is your friend. If you trust the trend, if you buy and sell stocks in the sweet spot to give yourself the highest probability to make money, you are going to make money more times than not, and you'll keep that money in your pocket because the trend is always going to tell you when to buy and when to sell. Now, let's get into some candles. So candles almost give us that final initiation of when to buy a stock. So there's a lot of different candles. And if you've seen my candle video, you can see that there's a lot. And I'm just going to actually draw some candles here just so you can see pretty clearly what we're looking for. So you're going to see candles that look like this, just kind of, these are called doji candles. There's not a lot going on with them. They kind of, stock price moves up in the morning, moves down in the afternoon, and kind of closes right in the middle. You may have candles that look like this, big long wicks on the top and bottom. That means that there's a lot of uncertainty. What does that mean? And we'll go look at some examples over here. That the stock price moved really high in the morning or afternoon, really low, but it actually closed in the middle of the day, meaning that there's not a lot of consensus. Typically on days like this, it goes back to volume. Typically on days when you see candles like this, the volume is very low. And that is where remember I said you need to have consensus. So if you have a volume bar like this and averages all the way up here, that's usually what you're going to see. Conversely, if you have a volume bar that's all the way up here, you're looking at probably an engulfing candlestick because the stock price starts down here, moves up throughout the day, and closes at the top. And that's what you actually see over here. Let's go and pull up the volume bars so we can see what happened here with Google. So on these days where you got this big engulfing candlestick, you can see that it kind of started here at the bottom, closed at the top, and if you come all the way down here, look where the volume was. All of these other days in here, you didn't have a lot of volume, but the day you got the most and you got to average volume, look at the candle. Now you come over here. You had pretty good volume coming in here. Pretty good volume coming in here when you had engulfing candlesticks. There's going to be times in the market that there's not, currently as I'm making this video, volume's a little bit wonky in the market. But the best thing to do is just go back in history. Go back in history and start looking and saying, okay, when I got this big volume bar here, did I get an engulfing candlestick? Yes, I had it, but it pulled back. Go figure out why. This is the best thing that I can encourage you to do. Here, you had some really good volume coming in here. Your best day of volume out of these 3 days, you had a really nice engulfing candlestick. And throughout history, you're going to see that. So I would encourage you to go and look. Now, there's other types of candles that can give you, a foreshadowing into what's going to happen next. And those are called hammers. If we look here, and I'm going to draw them for you. If I have a hammer formation that kind of looks like this. And why is it called a hammer? Because it kind of looks like a hammer. Here's your handle, and here's the top. And let's say you had a nail right here, and you were about to nail something. That's exactly what you were looking for. So hammer formations will typically indicate a change in direction. Also, you can have reverse hammers. It looks like an upside down hammer. Those are going to indicate changes in direction. So if we just look over here, you can see Google's stock price was coming up here. You started to come down. You got a hammer formation right here. And what happened to the price action? It changed on you. Now, it's not going to work perfectly every single time, but it's a pretty good foreshadowing. And remember, we're playing probabilities here. It's a pretty good probability maker of what's going to happen next. You can see here, you had a stock price that moved up and you came back down. You created a hammer formation and you fell down in price. Here you also had another hammer formation and it fell down in price. Let's see, a reverse hammer right here, you kind of ran up in price. Reverse hammer right here, you had a run up in price. So that's kind of what you can see. I would say take your chart and zoom it way out like this and go through and look for hammer formations and inverse hammer formations and see what happened next. So the big takeaway that I want you to take from the candlestick section here is that you have different types of candles. You have dojis, which you don't want to trade. You're going to see those a ton throughout a chart. They're not going to, you just don't want to do anything those days. You have candles with big wicks on both sides, which are typically going to have low volume. You want to avoid those. You're going to have your engulfing candlesticks, which are your buy signals. These are the candles that you want to buy. You're typically going to have a lot of good volume with them, and an engulfing candlestick means go and buy it. Now, the question came up in the candlestick video that I previously made. Do you buy during the engulfing candlestick or at the end of the day? You want to buy the candle when it's happening. You don't want to wait till the end of the day. Now, make sure the volume is there. Make sure you have enough volume to go and buy it. So if you have a lot of volume like this, let's say your average volume is here, this is the volume bar, yes, you would go and do it. If you had an engulfing candlestick like this, here's your average volume, and your volume is like this for the day, no, you don't want to, because what's going to happen to this? You're probably going to get some type of very big wicked candle that it's going to end up like this. You need to have the gasoline going into the car. So all of these things need to line up. But to answer the question, you can buy them during the day. You don't need to wait until the end of the day. And then a couple more candles. You have your hammer formation and your inverse hammer formation, which will typically mean a change in direction. And those are the 5 main candles that I would encourage you to look for, and go back and just try them. Try to identify them on charts. Doesn't matter what the ticker symbol is. Doesn't matter the time frame. Just go and try to find them. Now you might be thinking, and you might be saying, those hammer formations that you were talking about, I didn't really get them. What exactly am I looking for? How long does the wick need to be? If we look at this chart right here, does it need to be something like, is this a hammer? Is that a hammer right there? Well, to me, it wouldn't be a hammer, because the body of the candle is about half of the entire thing. You only have about half of that wick. So that's a great question. Is this a hammer formation? Well, I actually don't think it is. Now, a lot of trading is subjective. Don't forget about that. I want to look for something substantial. I want to look for something like this. You can tell that you have a lot of price movement on this day. You have a lot of price movement on this day. So if you don't just look at every candle, even these, I would just say, there's not really a lot going on here. This is a doji candle right here. You need to have, it needs to look substantial. And I know that can be hard for somebody that's new to look at it and say, what the heck is this guy talking about substantial? I think if the more charts that you go through and you notice, if we just look at this and say, yeah, that's pretty substantial in relation to something like this, you'll be able to start comparing and contrasting. Plus, you can ask me any of these questions that you have, and I'll say yes or no. But don't get discouraged looking at this for the first day. And remember, guys, when it comes to hammer formations, this is not something that you need to get the first day. Something that I would expect you to get the first day and identify is your engulfing candlesticks. You should be able to identify those, looking and saying, that is an engulfing candlestick, that is an engulfing candlestick, and dojis. And dojis just like right there, not really, even today on this chart that I'm looking at, not a lot going on. Those are the 2 that I would really want you to look for. The hammer formations and the big wicked candles, those are going to come. As you see more charts, you will get more comfortable with those. Okay, so a lot of people will say, Mo, every time I buy a stock, the stock price just goes down on me. Why is that? Every time I buy it, and all of a sudden, boom, it just falls in price. Why is that? Well, there could be a lot of factors to that, and I'm going to go over a couple of them right now. Number 1, support and resistance. Support and resistance is something that you'll see me talk about frequently. So how does that happen? If you don't have them on your charts, and you look at here, I don't really have them on my charts. What I have on my charts are my moving averages: 25-day moving average, 50-day moving average, 100-day moving average, 200-day moving average. Those play a role in support and resistance. But if I don't have those, for example, Google's coming up here to all-time highs. I can't really tell where it is. I have to look at this and be experienced. So you might be saying, how can I figure that out? Well, this is what I would encourage you to do. Take your chart and just zoom it back. Better yet, let's get rid of the moving averages for now, and let's just zoom it back like this. So we're going to go back on Google, and this is zoomed out to, here's 2020. This is actually going back to 2019. And I'm going to look at this and say, okay, where do I see really, really strong levels of support and resistance in here? Meaning, where are kind of the peaks where the stock price kind of hit and it fell back down, and it just consistently, no matter what year it was in, couldn't break that level? Where did that happen? So if we clear this out and start drawing, I'm just going to draw a line. I can kind of see here in 2021, I'm just going to draw a line going straight across. And you can actually see We kind of peaked here in 2021, and it actually moved up quite significantly here in February of 22, and it fell back down. Notice that. Now we come over here in January, February of 2024. It hit that same level, fell back down. It hit that same level here. It's trying to break through it right now, but it's kind of fluttering around this area. So to me, that's a very strong resistance point that it can't break through. Now, where's a level that it doesn't want to break through coming down? As in, okay, we can't get through it going up here, but let's look at the down. So let's come over here and let's just kind of draw a line, very, very casual line going through here. And you notice, why did I draw that? Well, after this big run up that we had, you had a pullback and you kind of consolidated here. It dropped below that price, and what did it do? It came up to that same price on that line. It went above that price and it came back to that same price on that line. Went above it again, same price on that line. You notice every time it moved up or down, it kept coming back to that line. That's a way for me to look at support resistance. So even here, this line played a role in resistance now. Coming up, it hit it, it fell back down. It hit it, it consolidated, got above, came back, consolidated again. So it's always at kind of that same spot. So now I'm going to just draw in two major lines. That's our line on top. That's our big resistance point that we struggle to get through. And here's a big support level that kind of holds up the stock. So why are those important? You might ask, why are those important? Because now I know if the price comes back down on me, I know that I'm going to have a lot of support right here at this line. And if it breaks that level and comes down to here, I'm going to have a lot of support in here. Why is that important? To know maybe where I exit my short, where I start a long position going back up. These are just indicators of saying, and maybe actually most importantly, don't buy or sell going into that line. So let's go over here to the daily chart just so we can zoom in and out of it again and kind of see those levels of support resistance that we had. So I'm going to draw the lines because the lines actually follow as I move the chart around. Here we go there. And here we go with that. So that line will stay there as we move the chart around. Now, as we come in here, I might say, you want to go and buy something, right? Well, you want to look and not buy right around here. Because this person, look at this, guys. This is actually a great example. That is an engulfing candlestick right there. That's an engulfing candlestick. You had halfway decent volume, nothing crazy. But look what happened after that engulfing candlestick. It fell right back down. Why did that happen? Because you were running into that resistance level that we drew in. That's exactly how it works. Now you might have bought somewhere in here and you might have said, oh, this is great. I'm moving confidently up, and then all of a sudden it pulls right back down. Why? Probably because that resistance level is there. But notice where the stock price fell to. It landed right on top of that support level that we drew in. So you can see how it kind of just bounces between this area. Yes, it creeps above. Yes, it creeps below, but it always kind of settles in that middle ground, even over here. You had a stock price move up, and look what happened for about 10 days. It just kind of consolidated. You had a bunch of doji candlesticks, a bunch of semi-engulfing. You had a bunch of inverted hammers, regular hammers just kind of sitting there, but it kind of stayed right on top of that line. That's the importance of resistance and support. You don't want to buy going into a strong resistance level. You don't want to sell going short, going into a strong support level, because you're not going to be able to make money. You need so much volume. You almost need some kind of hyper fuel in the car to drive yourself through those levels and just have a lot of people coming in. And you notice here, I'm taking it all back to volume. Volume is so important, even when it comes to support resistance levels. So you might be saying, all right, you've told me a lot of stuff about support and resistance. What are the big things to remember? Well, this is what I encourage you to do. Zoom your chart out and practice drawing those lines in. Doesn't matter what chart it is, I don't care what the time frame is, just work on going through and drawing lines in. I'm just gonna, even in such short areas, let's just go here. You're just looking and just drawing little short areas. You're almost making these consolidation channels. This is a consolidation channel. It's just bouncing in between those two lines that I'm drawing. I would encourage you to just continuously go and do that over and over and over. And also remember, those lines are basically drawn in for you here. They are your major moving averages, 25, 50, 100, and 200-day moving average. Now, another reason and the most frequent answer that I give, Mo, every time I buy a stock, the stock price goes down on me. Why is that the case? Everything lines up for me. I have my good volume coming in. I'm clear of all my support and resistance levels. I have an engulfing candlestick. But there's one thing that a lot of new traders forget to check, and that is your bid and ask. And that's right up there in that corner. Here's your bid price, here's your ask price, and there's the spread in between. Now, what exactly is the bid and the ask? Well, the bid is what you want to pay, or what the general market wants to pay for the stock price. So in this case right now, it's $158.45, and this is ever moving, all right? Now the ask is what the ask is from the market, what the market maker or market specialist wants to sell it for. And right now it's $158.42, and you can see the difference there is fluctuating between 1 cent and 2 cents. That is consensus. That is where you want to buy. If you don't take anything else away from this entire series that I'm doing right now, understand bid and ask. This is where people will get burned the most. They will not look at the difference and will say, why do I keep losing? If you look at this bid ask, it's a 1 to 2 cent difference. There will be times where there's a major discrepancy. The market maker wants you to pay some crazy amount. Let's say he wants you to pay $159.46, okay? So let's say that it's $1 higher, $159.46. And current price is $158.46. And that spread is going to be $1. So what happens? What's the case that happens? Well, you might be saying, Mostafa, when are you ever going to see spreads like this? When are you going to see $1 versus 1 cent? Well, go in the morning, 9:30 in the morning, and just watch it from 9:30 to 9:45. It's not going to always happen, but there will be, especially if you see a stock that jumps up 5% overnight. Go and look and just watch the bid-ask spread. The overnight trades are going to be settling, and the market maker is going to be trying to get as much money as he can. He's trying to play that arbitrage game, try to get that crazy difference in price. So maybe it's $1. So you go in and you execute your trade for $158.46. All of a sudden you get it at $159.46, not noticing that there was the spread of $1. Now what happens to the stock price? Well, there's other people still bidding at $158.46. You got it at $159.46. Now what happens to the stock price? It starts to pull back on you, and you instantly start to lose money because there's so many more people bidding in this $158.46 range. The spread was $1. You noticed it or not, there was a lot of manipulation going on. And that's the importance of the bid-ask spread. The bid-ask spread is so important. So you might be asking, well, what's the ideal number? The ideal number, if you're looking at a stock that's almost $160 a share, somewhere in the 1 cent to 5 cent range. That's what I like to see. Now, if you're looking at a stock that's maybe $500 a share, yeah, you can look and say 15, 20 cents because it's all relative. But if you're looking at a company that's $40 a share, $30 a share, and there's any spread that's greater than 2 cents, you do not want to touch that thing until it settles down and it's consistently 1 to 2 cents, because you are going to end up in the situation that I'm in. Maybe not this extreme, and I drew it to the extreme so you could really understand it, but you might see somewhere where there's a 30-cent spread and all of a sudden you buy something, and yes, it's going to pull back 20, 30 cents on you because the bid-ask spread and there's that manipulation going on in there. So now that we've got through a lot of the basics, and I understand if this is your first time, you're learning a new language here. So a lot of those basics, they could have been very challenging. You're not going to understand them your first time going through this. And trust me, guys, it took me a long time to get to this point. If you want to be able to just look at a chart and just identify things quickly as I'm able to do, it's going to take time. You will absolutely get there. I promise you, you will get there. But it's going to take time. It's going to take repetition. It's just like anything else in life. So let's get into some patterns, a little bit more advanced. And remember, this is your complete guide. I want you guys to keep coming back to this video over and over, not just one time. So you could come back to this video in a couple of months and say, all right, now I'm ready to look at some patterns. Let's go into the pattern section. So the first pattern is going to be very simple. This has everything to do with price action. So far, we've been looking at a chart that is candlesticks. Candlesticks kind of give you that You can see where the price moved that day, up and down. It gives you the wicks. It tells you engulfing. It tells you, did you run up on a price and pull all the way back down? That's what the candle is going to tell you. You can also pull up a line chart. And a line chart is going to be these jagged things all over the place. But these jagged things tell you something. When I'm looking at a company and I want to buy a stock, I look for what's called M formations when I'm going up. Nope. I look for what's called W formations when I'm going up. So I'm looking for these patterns right here where the price kind of pulls back and moves up and pulls back and moves up and pulls back and moves up and just continues on. But what are you noticing about these pullbacks that are happening as they're going up? The right side is higher than the left side. The right side is higher than the left side. The right side is higher than the left side, and so on and so forth. And what does that look like? Well, it looks like a W formation. It looks like something that you have three different types of Ws. You have a W that looks like this, where it's kind of the same all the way across. You have your W that looks like this, and you have your W that looks like this, which is more of an M formation, but we'll get into those. But this is the main W that you want to look for. The right side being higher than the left side, or higher lows. So the idea behind this is when the price runs up on here, let's actually use this little example right here. This is a good one. So right over here, you have a price that runs up on you and it pulls back. And you notice all of these things pull back. Pullbacks are something that you want to happen. Yes, that's contrary to popular belief. You're saying, I thought we were trying to make money here. Well, we are, but we can't just have things run up on us. And I'm going to show you a great example on Apple after this one's over. You need to have the run up and then the pullback in price, and the run up and the pullback in price. So I welcome pullbacks because why? It's creating those W formations. It's creating those higher lows. And as you get higher lows, it's creating a new support level. So this level right here was created. As this is pulling back down, it's going to make it very difficult to break through this support level that's being created. It might actually hit it and then bounce off and continue. That's the importance of the W formation. So you want to see things that look like this in an ideal world. It's not going to look like as perfect as this, but you're going to see this is a new support level, new support level. So as the stock price pulls back down, odds are, even if it breaks this level, it's going to stop here and it's going to continue its climb. You can notice. There we go. There's your higher lows, higher lows. And actually today on Google, it's creating one of those new higher lows so it can keep propelling to the top side. Now, what happens if you don't get an M formation like that? What happens if you get what I call a flagpole pattern? Let's go over here and let's go to Apple. This is a very, very interesting flagpole pattern that happened on Apple years ago. It was right in here. So Apple, this was about 12 market days in a row that the stock price just kept climbing. Let me pull up a candle chart just so you can see it. You notice here, it was just green every day, every day, every day. It just kept going higher and higher and higher every day. And I said, there is no chance that this is sustainable. I think this was 2022. Yes, no chance this is sustainable. Because if you don't have those pullbacks in there to be created, well, guess what can happen? There's no support. Remember we talked about if you go up like this is the new support level for this. So if it pulls back down, it can actually bounce off of it and rebound back up. Well, you don't have any of that. If you have a flagpole going straight up, it can just come straight back down. Or even worse, it can come back down, creating W's the other way, or M formations coming back down, creating lower highs, where it's just the opposite. You're going to run into these resistance levels and pull back down. Resistance level, and you're not going to be able to break them. So what happened with Apple here? It ran up 13 days in a row, and then what happened? It started to come down, and it started to create these M formations. And you see how long it took for this price to get back to that level. This was, we'll call it April 1st of 2022. This was June of 2023 that it took to get back to that level. And I think a lot of this is attributed to that flagpole that was created, because these levels of resistance were built in so strong. Yes, you tried to climb here. You got a lot of great W formations, but look, it ran right into that resistance level that was created. And it took a lot of time and agony. Look, this thing went down almost $120 a share before it ran back up. So that is why these patterns of W, like this, M, when you're shorting, coming down, and flagpole, you'll see me draw it like that. I usually do like a face on it. Those are your main patterns that you need to look for as far as the price action goes. Pull up a line chart. So I would encourage you to do this, guys. So you might be asking, all right, how can I learn this? How can I figure this out? Because to me, this looks like a ton of squiggly lines that are on your screen right now. Go in and just zoom back exactly what I did. Go through Apple and just turn on a line chart and just go, okay, just pick somewhere random and just say, all right, this was creating W formations very nicely. W formations in here just being created very nicely. Then go to another chart. Let's just type in, I don't know, Best Buy. The first stock that came to my head. Go and look and see what happened. All right, I had a flagpole pattern right here because there were no W's, and what happened? It pulled straight back down. Let's see if we can find any W formations in here and just go through like that and do the same thing over and over and over again. Repetition is going to be what's key for this one. Okay, so another pattern that we look for, and I'm going to go to an NVIDIA on this one. This one is called a head and shoulders pattern. So a head and shoulders pattern is basically, and we might have to go to a new stock because NVIDIA has been so strong for so long. It basically is going to be a head, and I'm going to draw a little face, and shoulders. And that's what you're going to be looking for. Now, how can we find that on a chart? Let's just start going through. Let's go back to Google. I'm sure we can find some head and shoulders here. Let's see. And guys, the thing about this is just find your charts, find your patterns and see what happens. Okay, so I noticed I identified a head and shoulders pattern here. So what happens on a head and shoulders? Well, the stock price runs up, it hits a certain level and it kind of doesn't do much. And then it pops out. And once it pops out, it's important. This is where you can identify the head and shoulders pattern being formed. So you have this kind of almost a W formation that was being created. Now it's important what happens next over the subsequent days, weeks. You get a stock price that pulls back on you below the previous shoulder. It creeps back up, and then what happens? Boom. And you notice here, let's just draw it a little bit more cleanly. Here's your head. And here's your shoulders. So you can see that there's that head and shoulders pattern. Now let's go and try to find another one. Let's go try to find something. Let's go to an Apple. And the reason I'm pulling this up on such large companies is I want to show you guys that these patterns happen everywhere. It's not just on a small rinky-dink company. No, these patterns happen on every single type of chart. So here's a head and shoulders pattern. Here's your head. Here's your shoulder, and here's your shoulder. So if we draw it, again, of how it kind of developed, we'll use purple here. You had a price that came down, moved up, pulled back down, moved up and peaked, pulled back down, hit that same level as the shoulder over on this side, and then the stock price fell on you. And this is the trajectory you're going to see. You're going to see your shoulder. Let's draw it in order. You're going to see shoulder, head, shoulder, and then what happens? This. So it's a very bearish signal. It's a very bearish signal. So how can you find these? Well, it's the same thing. Go to past charts and just try to identify them. So the next big pattern to identify is an ugly face pattern. And these are weird names, but I actually am going to identify one right here on Apple. And then I want to go to Costco because one is forming in real time. So what is an ugly face pattern? Well, it's not really, almost looks like a smiley face, but I call it an ugly face because of what's going to happen. And it kind of looks like that. So you have your eyes, you have your mouth, and I always like to draw in a nose. And what are we seeing? Well, this is right up here. So you have your two eyes. Here's your two eyes. Some people call it a double top. And here's your face. And what happens after that? Well, you get a big pullback in price. It's almost the same thing that happens with a head and shoulders pattern. So what are you looking for? Can you identify this in real time? Absolutely, you can identify this in real time. So you have a stock price that moves up and it peaks somewhere, okay? And You're not really identifying it yet. I'm just drawing it in here for illustration purposes. Then you get a pullback in price. You can start to identify it when you start getting this move up in price. And you say, I want to see if this thing just hits that level and stops and peaks and creates the second eye. And if that second eye happens, and there's your ugly face, more often than not, this is going to happen. It's not going to be instant, but you can see it trickled down, it tried to fight it, and then it just completely failed. And this is Apple. This is Apple. So let's go to Costco. Costco is happening in real time right now. So for those of you that are watching really early on to this video being posted, I want you to pay attention to Costco and just see what happens here. See what happens with Costco, because what we have right now is here's your one eye, here's your face, and here's the other side of your face. I'm curious to see if this happens. And it'll probably pull back next to its next support level. And you can see I'm just drawing in support levels. It's very easy to do once you get the reps. You just draw in those support levels. And I'm expecting Costco to pull back somewhere in this range. It might consolidate around here at the bottom of the face, but I think it's going to get somewhere in this range coming down. Please pay attention to Costco if you're watching this early on. And if you're not watching this early on and you're finding this some time from now, look and see what happened in this time frame between March 27th, 2024 and April 16th, 2024. That is your area that I want you to pay attention to and see if it played out like that. You're probably thinking this is a lot to be thrown at me in one video. Well, that's why I remember this is your complete guide. I want you guys to continuously come back, and we're chaptering this so that you can consistently come back to it and look and say, all right, I don't need to go through the whole video every single time, but I can come back and go to specific chapters. One of the chapters is going to be right here on the 50% rule. The 50% rule is so incredibly important. This rule has saved my butt so many times. Boeing in 2020 and Carnival Cruise Lines in 2020, most notorious for saving my butt. I absolutely made a killing on these trades because of the 50% rule. So what is the 50% rule? 50% is basically, you have your high up here, you have your high price, or you could probably even draw it in here. Then you just draw in your low. So these are basically, well, you know what? Let's go to the extreme. Here was your high. This was pre-COVID. Here was your low during COVID. And the middle between the two is right about there, and that's 50%. It's 50% because this line is 50% of the high to low. So all of this area on top, it's called overhang. All of this blackness, overhang, overhang, overhang. What is overhang? It's negative pressure being put on the stock. And why does this happen? Well, it happens because the person that was up here that bought pre-COVID in this case, they started losing money and they said, oh, we're probably fine. This is when coronavirus happened. Boom, come all the way down here. Well, this person the people that were buying back in here, they're saying, man, if I could just get back some of my money, I'm going to exit this thing. The stock price runs up on you. And all of these people here are like, you know what? We bought up here. We're just going to sell. And what happens? Boom, they sell. And the people that didn't sell in here, they're saying, man, if I could just get one more good run up to that level, and look, you're right up to that same level, man, I'll take my money and run, and I'll just take the loss. And they do. And what happens? Boom. These people still didn't sell, and it just keeps happening over and over. And you notice, so this was 2020. Guys, it is 2024. I'm recording this video. We still have not gotten over this 50% line. Yes, it's tried multiple times. Multiple times it's tried. You can even see here, it was trying to really push to these levels. It just can't do it. Carnival Cruise is another great example. And then I'll walk you through exactly where I bought, where I sold. Carnival Cruise, here you go. Here was your high pre-COVID, post-COVID, middle ground, right about there. Overhang, 50%. And guys, you're going to see this in so many different charts right now. It runs up, same thing. They just want half their money back, half their money back. These people just want to get out, just want to get out, just want to get out. And they have not been back to that $30 price. Now, how did I use this to my advantage? Well, during this time, I bought back in here, $7, $6, whatever it was, because I was like, this is ridiculous right now, of this almost flagpole to the downside, totally ridiculous. And I bought, and I just held it, and I kept holding and holding. And when I got in here, this is where I started to get a little nervous, because it had failed this 50% rule here. It failed this 50% rule here. So I actually ended up selling on that day right there. It was in April. I remember I was walking in the park. I got an alert that it hit my 50% level. It was about $30 a share, $29.85 a share, whatever it was. And I exited all my shares. And it was a great move because yes, it peaked through a little bit. It got a little over $30, but it has not come back to it since. The entire reason that I sold was 50%. Now, when I come over to Boeing, same thing happened. I remember buying Boeing over in here, $100 a share. I was like, this is crazy. I think I bought it at $99 a share on the nose. And I ended up selling around this area right here because I identified, well, a 50% point is being created. A 50% point is being created. Here was my high, here was my low. I knew, yes, I thought that it would creep above 50%, but I didn't think that it would be sustainable. And you can see since then, it has absolutely not been sustainable. I wasn't using this area, I was using this area. So for 50%, you're probably asking, where do you go with this one? Do I go back all the way to the all-time high of all time? No, you just go back to the last 52 weeks. So in this case, this is where I went to. If you want to go back prior, you could probably find 50% within 50%. Like here, you probably could have found 50% in there. You can see it struggled for a little bit of time, but I like to go and zoom it all the way out as far as I can go, see where the main 50% is, see where the majority of overhang is, and that will benefit you the most when it comes to the 50% rule. I always sell stocks going into the 50% line. I just do it because there's not a high probability that we're going to go out above that level. Okay, so when it comes to finding a stock, there's different ways that you can find stocks. You can go to Yahoo Finance and look at the top movers of the day. You could pick maybe companies that you just really like. Maybe you could pick Netflix and Apple and et cetera. Just make sure I always stick with the same 5 stocks and trade those over and over. Now, when it comes to identifying stocks that are really, really solid at the time, or stocks that are just not going down, well, I look for companies that are called power stocks. So what is a power stock? Well, a power stock is something that is hitting 52-week highs, and it's over all 4 of those major moving averages that I told you about a little bit ago. So here's your 4 major moving averages, 25, 50, 100, and 200, and it's making new 52-week highs. And in Amazon's case right now, it's working at eclipsing all-time highs. Now it's stuck. So if we just take it all back to resistance and support, it's just stuck right here. It cannot break through that level. Why? Well, look how weak the volume is. The volume is incredibly weak compared to back in here. Look how much more volume there was back in here compared to what we have going on right now. It's just not there. It's not going to eclipse those all-time highs with that kind of volume. But it's technically a power stock right now because it's making 52-week highs, and it is over all 4 of these major moving averages. So if you're looking for companies that have a lot of strength behind them, go and identify power stocks. I want you to go through and just start looking for power stocks. I'm typing in some banks right now because I have a feeling banks might be them. Nope, banks have pulled back significantly. Go through and just say, all right, I need to find stocks that are making 52-week highs and overall 4 major moving averages. You don't need to buy them, but you need to know how to identify them. So when the opportunity comes, you can buy them. So power stocks, 52-week high, overall 4 major moving averages. And what you're going to see with these is on your long-term stochastic, they're going to be in the overbought area. They're going to be up here in the overbought area, just going sideways. And as they go sideways, what happens to the price? The price just keeps going higher. Now, this isn't the prettiest power stock in the world. There are not a lot of power stocks out there right now because there's just not a lot of companies that are making these new highs because of probably the uncertainty that's going on with the market and interest rates, et cetera, at this moment in time. But you need to look for these beautiful stocks. If we just go back to Google, back in here was such a beautiful power stock. It was, trust me on this one, it was making new 52-week highs over all the major moving averages, came through the sweet spot so nicely, and look how long it just stayed in the sweet spot. Costco is another example of this, going back a few months, came through the sweet spot so nicely, just went sideways up here. Yes, you had some moving around up in here, a little uncertainty, but overall it just continued to climb. Same in here, came through the sweet spot, went sideways for quite some time. So the stochastic is going to be important to pay attention. The trend is going to be up in the overbought area, going sideways. So when it comes to dog stocks now, which is basically the opposite, dogs are interesting because they get so beaten down, the price just keeps coming down, that they get all the way to the bottom here on the stochastic. And you're saying, well, why would you want to look at that? You want to look at it for a couple of reasons. Number one, maybe Zim is an extreme example, but pay attention. Maybe it's something you throw a tracker share on. Buy one share for $10 a share, and you say, you know what? I'm just going to let this thing sit. Worst case scenario, the company goes out of business. I lose $10 a share. Best case scenario, this company starts to go like this. And let's say that Zim actually started moving up like this. Well, you would have been the first one to catch it because it would have been so quiet in here. It would have been moving. It would finally start to get momentum. It's starting to creep up. A lot of institutions are coming in, volume's coming to the stock, and you were in it so early on back in here that it just explodes and you make a really nice profit on it. That's the benefit of dog stocks. Dog stocks nowadays are a little bit tougher to find. Why? Because a lot of stocks that get beat down deserve to be getting beat down, and they're just not going to climb very far. But I do think that we're getting to a time where dog stocks are going to be incredible opportunities. So look for companies that have a stochastic all the way on the bottom, and it's just going sideways for a long time. As the stochastic goes sideways, what happens to the stock price? It just continues to fall. That's a good thing for you. Just pay attention to it to creep, creep, creep. Once it hits that sweet spot, you can start entering. Institutions will pay attention. Volume will come in. Stock price will go up. It's as simple as that when it comes to dogs. You just have to pick the right dogs. So that was a lot to throw at you. And you might be looking at me saying, oh my gosh, this is so much. How am I supposed to put real money into this? I don't think you need to put real money into it. As a matter of fact, I spent the first 6 to 12 months. Remember, I was 14 years old, but the first 6 to 12 months of just trading on paper, meaning that I would either enter my trades in an Excel file, I would use TradingView. Well, we didn't have TradingView back then, but TradingView, they have a paper trading area. TD Ameritrade, Schwab has a paper trading area, Thinkorswim. You can find paper trading, maybe Webull. There are so many places that you can paper trade. If you don't want to use a program, pull up your chart system and be honest with yourself, but enter your trades into Excel. Don't say, I would have entered there, but now it's up here. No, you wouldn't have entered there. Be honest with yourself and say, I would have entered at this price. Get a realistic win-loss percentage for yourself. But I truly encourage you to go to a TradingView, go to a TD Ameritrade, go to a Thinkorswim, whatever it is, Webull, and paper trade and execute those trades. I know Interactive Brokers has one. Execute those trades and you are going to see where you are on paper. Do it as long as you need to. If you need to do it for a year, it's no big deal. Let's say you're like me, you're 35 years old. Well, let me tell you something. You haven't traded a stock for 35 years of your life. It's not going to hurt you to not trade a stock for another 3 months of your life, another 6 months of your life. Get comfortable. Understand it. I'm telling you, it's completely different when real money is involved. When you're paper trading, you're like, maybe if I lose, I lose a little bit. Maybe it hurts a little bit, but you're not losing any real money. If you make a big win, you might be like, that's awesome, but it's not real money. It's totally different when you're trading real money. So when you go through this, make sure you have the patience to do it. Religiously do this. Every morning, I encourage you, go through 500 stocks, download the S&P 500, put it on your watch list, and flip through and look for W formations that day. Look for 50% rule formations the next day. Look for power stocks the next day, dog stocks the next day, etc. Just keep moving through your patterns and saying, okay, I see this pattern. I'm going to go through all 500 stocks. It sounds ridiculous, but that is what's going to make you an excellent trader. Another question that I often get, what time should I be trading? Well, for me, I never start trading until after 10:06 in the morning. And this all goes back to the bid-ask spread. Bid-ask spreads are going to be shifting around for about the first 35, 36 minutes of the market. So let all that calm down. After 10:06, reassess, make sure your bid-ask spreads are calmed down. That's kind of what I do. That's kind of part of my checklist. I say, let's let the bid-ask spreads calm down. Then I don't have, it's one less thing I have to be super hyper focused in on because I know that the overnight trades are going to be calmed down. So anytime between 10:06 and the end of the day, you can go and trade. If there's not a lot of volume in the middle of the day, maybe go and look at your trade at 3:50 p.m. Eastern time and say, all right, did I get volume by now? Can I enter the trade? Should I exit the trade? What have you? Just depends on where the stochastic is and where the volume is. So if you want to get to know my story and how I started and how all of this came about, go watch this next video. It explains my entire story of how I dropped out of medical school and where I am today.